Good afternoon and welcome to today's webinar, Understanding the New Digital Assets Annex for the GMRA and the GMSLA. We're pleased to have you with us for this important educational session hosted by us, the International Capital Markets Association and the International Securities Lending Association. I'm Dina Saudi, a Senior Director and Associate Counsel here at ICMA, and I'm joined by Tina Baker, Head of Legal Services at ISLA. The Digital Assets Annex, which supplements the Global Master Repurchase Agreement and the Global Master Securities Lending Agreement, has been developed through a collaborative effort between ICMA, ISLA, Clifford Chance, and a joint members legal working group. In light of its recent publication, ICMA and ISLA are excited to offer this opportunity for market participants to gain a deeper understanding of the new documentation and its uses. The session will be led by Michael Brown, a partner at Clifford Chance, who is joined by his associate Samuel Steinert, who will provide a comprehensive overview of the annex. They will cover several key topics, including the background to the development and timing of the Digital Assets Annex, the types of digital assets covered by the annex, the election processes outlined within the documentation, and the changes introduced to accommodate intraday repo transactions. Following the presentation, we will host a Q&A session. You can submit your questions using the Q&A chat function at the bottom of your screen. Please note that all the questions are anonymous to other participants, visible only to the host and the presenters. We'll also use this opportunity to address some of the questions that we received from participants at registration. We hope this session will provide valuable insights into the new Digital Assets Annex and its practical applications for your business. Thank you for joining us today, and we look forward to an engaging and productive session. Now I would like to hand over to Michael. Thank you.
Thank you very much, Dina. So there's a number of ways of approaching a discussion of the digital assets annexes, but given the time constraints today and the fact that there are 4 separate annexes for different versions of the master agreements, we think the best way to approach this is to examine the annexes really by theme, so that you can have a detailed understanding of the relevant issues, irrespective of what digital asset use case you're looking at or which version of the master agreement is applicable to your transactions. With that in mind, we're going to run through a few different points. We'll start off by considering what the scope of the digital asset annex is. So what types of digital assets are covered by the annex. We'll then be discussing some of the key amendments to the standard terms of the relevant master agreements before looking at variations between the forms of the annex, because there are some material differences for some of the agreements, before finally looking at the key takeaways for you to reflect on when you're making use of the annex or examining any given use case. And then obviously we'll be turning to the Q&A that Dina touched on earlier. With that in mind, let's focus on what types of digital assets are covered by the annex. And this breaks down into 3 categories. These categories were selected by the working groups. In particular, digital cash, asset-backed digital assets, and tokenized traditional securities were the original scope of the annex. And that was the result of feedback that ISLA and ICMA received at the outset of the project and leveraged some of the definitions from a white paper that ISLA published prior to the project taking place. During the lifespan of the project and during detailed discussions about what use cases member firms were currently engaged in, we added platform transferred securities to the scope of the annex. But what does that all mean? Well, first and foremost, we'll look at digital cash, which is hopefully relatively intuitive. It can take a lot of different forms, but 2 of the main ones would be central bank digital currencies or a tokenized deposit. The amendments needed to cover digital cash are relatively small and in many cases quite clarificatory, but it does tie into some of the termination rights we'll be looking at later on. Perhaps more material are asset-backed digital assets, including tokenized traditional securities and platform transferred securities. But what do these mean? Well, asset-backed digital assets were the starting point for the annex, so let's look at those first. And here what we have is digital property of some kind that gives you rights or ownership values in respect of some sort of underlying asset. So what you own is a digital token, you have digital property, but it gives you rights in relation to an underlying asset or its value is determined by reference to an underlying asset. And this is a really key point because the property that you have is a digital property. And that's in stark contrast to a platform transferred security. For a platform transferred security, the only asset that exists, the property that exists, is a traditional security. And what's happening is the platform is being used to transfer it more efficiently or to represent ownership in a more efficient manner. Usually the transfer takes place on a near instantaneous basis. And obviously that leads to a little bit of confusion between tokenized traditional securities and platform transferred securities, because from an economic perspective, these are largely one and the same. If you have a piece of digital property that represents an underlying traditional security, and which maybe you can exchange for an underlying traditional security, you would obviously expect the value of that digital token to closely track that of the underlying security. A number of times we've felt it's very helpful for firms to have a detailed understanding of the difference between these two types of digital assets, i.e. tokenized traditional securities and platform transferred securities, because it's very helpful for them to be able to explain to their counterparties and internal teams how the annex is working and why there are distinctions between these types of assets. But also it feeds into a lot of the amendments that are made and why they have different amendments that we'll coming on to shortly. Usually the most intuitive explanation for a tokenized traditional security is to liken it to a global depository receipt, or a GDR. Because what you have in a GDR is you have a security issued by the depository, so you have, which gives you rights against the depository. And what the depository does is own some sort of underlying asset, for example, shares in an entity that you can't easily hold directly. The GDR allows you to exchange your depository receipt and receive the underlying asset. So you would expect in most cases the value of the GDR to closely track that of the underlying asset. But what you own is the depository receipt. You're not entitled to go up and vote directly in respect of the shares of the underlying asset. You have to direct the depository. And this is a lot like a tokenized traditional security. You own a digital asset, but that digital asset might be exchangeable for a traditional security. And that is distinct from a platform transferred security, where what you own is the traditional security. And that will come in great deal of detail when we look at the concept of equivalent securities for the asset classes, because it goes to the heart of what do you own, what do you transfer to your counterparty, what do you get back from the counterparty, what do you value on a day-to-day basis during the life of the trade, and of course, what do you value if a default occurs? Now, if we turn from there to consider the categories of digital asset that are not covered, you can see there's a number of different categories listed, and it's by no means exhaustive because clearly digital assets is a pretty broad church. But we've picked these for very specific reasons. So cryptocurrencies, first and foremost, were actually a category of digital asset that there were a number of requests to cover at the outset of the project. There are obviously well-documented examples like Bitcoin and Ethereum. Obviously, cryptocurrencies weren't covered, and there are a number of reasons for that. Perhaps first and foremost, cryptocurrencies don't fit in as well with the core architecture of the existing master agreements, and they don't necessarily fit in as well with the business cases of the most prominent member firms of ICMA and ISLA, and therefore it wasn't necessarily appropriate to cover them at the outset. People do enter into securities financing transactions with cryptocurrencies, but they typically use an independent master agreement, their own drafting or based on other market standards, because there are a number of bespoke provisions which you would want to include, which don't gel perfectly with existing securities financing documentation. And it would obviously be helpful for people to consider that, and maybe people want to margin them separately and collateralize them differently, simply because the regulatory capital treatment of these assets can be quite distinct. Native digital bonds were also considered, and in fact, they came close to being added during the life of the project. There were some requests to do so. There were also some requests to not do so, and therefore at this point, they are not covered by the annex. But hopefully the annex would be a useful starting point to think about how you could approach the issues in relation to native digital bonds if you want to enter into SFT transactions in connection with them. Finally, of course, there are other categories of token. The digital assets world has a huge range of tokens out there in the market, and some of those perhaps don't naturally lend themselves to securities financing transactions. If you have a token that gives you access to a platform or a service, it doesn't neatly fit into the concepts of the agreement, and it doesn't necessarily suit the existing business uses. And there wasn't a lot of pressure to cover these. But going forward, of course, you may find that there are use cases for other categories of token that you do want to consider. And again, hopefully the annex will provide you with a useful starting point and common standards that you can reference when you apply that to those categories of token. But what about the documentation itself? What sort of amendments get made to the master agreements to reflect the use of digital assets? Well, first and foremost, obviously, there are a lot of technical changes that get made. These are largely clarificatory. You amend definitions around securities and cash to make it very clear what's in scope. But these would be distinct to each master agreement, and they're not particularly useful points to understand when you're trying to explain how the annex works to your counterparties. They're relatively self-explanatory. Equivalent securities and market value are much more significant. And I'd like to really focus on the equivalent securities point for a while. Now, this really goes to the heart of the question about what the property is and what do you own that we looked at earlier when talking about platform transferred securities and tokenized traditional securities. Why is that relevant? Well, if you're looking at a platform transferred security, as we said, the only property is the traditional security. It's being transferred in a new way, a faster way, a more efficient way, but the actual asset itself is the same. Nothing has changed. And on that basis, the equivalent securities are what they've always been. There's no change to be made to how the documentation works. You don't need to value anything differently. You don't need to think about the transaction in a unique way for valuation purposes. But that simply isn't true if you have an asset-backed digital asset, which will obviously include a tokenized traditional security. Because in that instance, the property that is transferred is the digital token. It's digital property. And therefore, the equivalent asset at the end of the transaction is a similar token, an equivalent token. It is not the underlying asset. And that leads to a couple of points. First and foremost, at the end of the transaction, if someone tries to settle by delivering the underlying asset, you are not necessarily obligated to accept that. You might want the digital token for particular reasons. The next, of course, is around what you value if a closeout occurs. If the parties end up cash settling a transaction, somebody has to calculate the default market value of the relevant asset. And the relevant asset here would be the equivalent securities. It would be a digital token. However, in the course of the working group discussions, a lot of focus was given to this point because out of all the digital asset platforms out there in the market, it was accepted that currently liquidity in the main market is more significant. And it was felt that there would be a number of circumstances where firms might be valuing a digital token, but find that the value isn't necessarily reflective of the underlying asset, and they may not wish to justify that valuation to an insolvency official if their counterparty has defaulted and gone insolvent. And on that basis, the annex gives people the right, but not the obligation, to value the underlying securities, the underlying assets, rather than the digital token. In this way, member firms get the choice. They have the option to value the digital token if they feel that's most representative, perhaps if the platform has become inaccessible and there is a good reason for the justification, but they're not obligated to do so. If the platform just doesn't have the same liquidity of trades and prices on the platform are therefore lagging slightly behind the real market, they might prefer to look at the underlying assets, get more up-to-date values of those, and use those to demonstrate to their counterparty and the insolvency official what valuation should apply. And that can be particularly the case if there's a number of limited participants on a digital platform, because then obviously there might simply be a shortage of quotes to obtain. That leads, of course, to the idea of the market value itself. You only use the default market value on a closeout, but the market value gets used on a day-to-day basis for these transactions. And here again, we have an option for firms to agree something. And this is one of the first instances we've discussed where firms are expressly flagged to have the option to agree something specific outside the terms of the annex. Obviously, if the annex simply says that firms are free to agree to calculate market value of asset-backed digital assets by reference to the underlying assets, that isn't actually a change to the terms of the agreement, because firms are always free to agree to amend the terms of the agreement and to value things independently. But the working group thought that there were a number of instances where in the digital asset space, it might be prudent to flag those kind of options to participants in the market, simply because there was an expectation that in many cases it would be appropriate to make those choices. And by including that optionality in the annex, by flagging that decision in the annex, it would make it very clear that there's an expectation that a number of people in the market will want to take that approach. So all that means is that on a day-to-day basis, firms can agree that if they have a tokenized traditional security, rather than looking at the price of the security on the digital exchange or platform, they can look to the underlying assets and use those valuations in order to determine the market value and whether or not any margin calls or collateral calls are required. And obviously that helps preserve the netting analysis, or at least the netting treatment. But speaking of termination rights and netting, one of the other very key decisions that gets made in the annex is around termination rights. And I think it's important to emphasize here, when you're speaking to participants for the first time, that most digital assets rely on the use of some sort of technological platform to handle deliveries or record ownership of the digital asset or token, whatever it might be. And a key question that the working group had to wrestle with is, what happens if that platform goes wrong? What happens if something goes wrong with people's access to the platform, even if the platform is operational? And that leads to these two separate events. Why are there two separate consequences? Well, that flows from the importance of the platform and the type of asset you're using. But let's examine that now. So on the right-hand side of the screen, you can see that there's the concept of a platform event default. And this is appropriate where you have a platform that is essential to the operation of the trade. You cannot transfer the asset without access to the platform. And it's also important that it's fault-based. So if a counterparty has been expelled from a platform and the platform is essential to the smooth operation of the trade, this is where you are likely to find yourself. And what this does is allows the non-defaulting party to terminate and cash settle the relevant transactions. So if I have transferred an asset-backed digital asset and I am expelled from the platform, you will not be able to redeliver that asset to me because the only way to deliver it to me is on the platform. I no longer have access to the platform. It will therefore not be possible to settle the trade in the ordinary manner. You therefore want to cash settle the trade as soon as possible. You don't want to try and unwind the trade as usual, wait for me to fail to deliver, any grace periods to elapse, and then terminate. You would like to cash settle now because it lets you manage your position much more efficiently. And that is what a platform event of default is for. It's there to ensure that parties are in the position they're expected to be if it is no longer possible to run that trade. And therefore, this is inevitably of most relevance to asset-backed digital assets, including tokenized traditional securities, and also to digital cash. But this isn't really relevant to platform transferred securities. And the reason for that is there is no independent property for a platform transferred security. The only property is the traditional security, and it would always be possible to deliver those off platform. So you don't need to cash settle them, even if somebody is at fault and has been expelled from the platform, because the trade could unwind in the ordinary manner outside the platform. It might take longer to settle because you have a different settlement timing, but it would be possible. And that leads to the explanation for the other right, which is where the trade becomes terminable on demand. Now, obviously, in many cases, there will be no change at all because lots of trades in the SFT market are terminable on demand. They're just on-demand trades naturally. People are running off the exposures very quickly. But obviously, there are term trades out there in the market. And if you have a term trade which is reliant on a platform, or in which you see a platform transferred securities additional efficiencies as central to the trade, you may wish to unwind the position if the relevant events occur and a platform ceases to be available for whatever reason. In that circumstance, the trade becomes terminable on demand. There is another consequence, of course, of the platform being unavailable. And that can be that the platform might be unavailable because it itself has ceased to operate or because an independent third-party service provider has ceased to operate. So you don't necessarily want to go to cash settlement, in which case you would also use this provision and you would attempt to unwind the trade in the ordinary manner. In certain circumstances, it might not be possible to do so because the platform isn't available for an asset-backed digital asset, in which case you would have a settlement failure and the parties would cash settle that individual trade. But obviously they would be entitled to agree to continue the trade in the ordinary manner and wait out the situation. There was a further consequence, though, which is if you're relying on a platform for collateral which consists of digital cash or asset-backed digital assets, it was considered appropriate to exclude those from the collateral calculations for a very simple reason. If you can't access the collateral, it will be difficult to get full value of the collateral. It might take you a significant amount of time for you to have access to those assets again. And so the decision was made that we would exclude them from the collateral calculations until the position unwound or the platform became operational again. And that entitles people to just call for additional collateral. The trade doesn't have to terminate, but I might have to post alternative collateral to ensure the smooth running of the trade. The next slide shows the last key point that we want people to take away, which is that the annex is a starting point for discussion. It isn't necessarily appropriate to never amend it or modify it under any circumstances. We've already seen there are a number of options for people to elect. People might make elections as to how to calculate the market value of asset-backed digital assets, or they might elect to waive the right to terminate on-demand term trades in relation to platform-transferred securities. If they don't consider the platform to be essential to the operation of the trade and it's just a bonus, they might want to agree upfront that that termination right simply won't apply. Or they might decide that they want to carry on valuing the asset-backed digital assets in those circumstances. Maybe they have a way of extracting the trade. Maybe the use case involves people automatically converting the asset into the underlying, and so it's not appropriate to cease to value it entirely. So there's an expectation that firms will be looking at the annex and adjusting it as necessary for the use cases they're entering into, and that might be reaching pre-agreement, it might be modifying provisions, it might be descoping assets from the annex if they're not planning to make use of them. And with that in mind, I'm now going to hand over to Sam, who's very kindly agreed to talk about the variations between the forms of digital asset annex.
Thank you very much, Michael, and good afternoon, everyone. I think one of the key points we think it's worth taking away from this session is that we've tried to be as consistent as possible across all four annexes. So for the GMSLA 2010, the GMSLA 2018 Pledge Documentation Annex, the GMRA 2000 and the GMRA 2011. We're hoping that when you pick up any of these annexes, you should be able to read across all of the concepts that Michael has just spoken about. And largely the way that those annexes incorporate digital assets into the wider documentation is consistent. That being said, there are a couple of material differences which we think it's worth bringing your attention to. The first is in relation to the GMSLA 2018 Pledge Documentation Annex. By way of background, under that set of documentation, the collateral leg is governed by a security interest rather than a title transfer arrangement. This means that the pledged GMSLA sits alongside security interests of various tri-party custodians that the ISLA publish on their website, and the custodians also have their own account control agreements which sit alongside those security agreements. It's therefore important when you're thinking about the pledge documentation about how that fits in with the kind of wider ecosystem. Wider ecosystem documentation. And the decision was made that it wasn't appropriate to open up those security agreements without input from the tri-party custodians. In addition to that, the question of security over digital assets raises questions of what's covered, what legal changes are needed to the security agreements, if there are any jurisdictional issues. And on the basis of that, the decision was made that it wasn't appropriate at this stage for the GMSLA annex to cover the collateral leg of the 2018 GMSLA. So that document only covers transactions where the loan securities are digital assets and not where the collateral leg includes digital securities. We suspect that as and when tri-party agents have further developed their documentation, that this may be something that is picked up in future, but for now, that's not the case. The second key difference between the four annexes is between the GMSLA annexes and the two GMRA annexes. And here we've incorporated a provision which governs intraday repo transactions, which was a key use case and an area of focus for members in the repo market. We just didn't have the same feedback from members who use the GMSLA. So it's not covered by the GMSLA documentation. Now you can go and take a look at the paragraph we've included on intraday transactions in the GMRA annexes. It's paragraph 11. It's intended to be as flexible as possible for market participants when they're using it as a starting point. But there are probably two key concepts which we've included, which are worth just briefly covering here. The first is the concept of relevant time. This is essentially the close of business concept. When we were drafting this provision, we asked the working group the question of what would happen to an intraday transaction if settlement didn't occur on that same day. And the answer that came back is that it should cease to be an intraday transaction. Now, in order to build that into the documents, you need a cutoff time, a close of business concept. And so the relevant time definition is intended to capture that. Really, what we're trying to get at is it's the last time on which all settlements on all relevant platforms can be made on the same day. Once you go past that time, it's no longer possible to make settlements in respect of that intraday transaction on all platforms, and therefore the transaction will cease to be an intraday transaction. The second key concept related to intraday transactions that it's worth touching on is the price differential concept. Now, we've taken the existing definition in the standard documentation of price differential, and we've added a concept that makes it possible to calculate partial days, essentially a minute count. Obviously, when you're doing intraday transactions, you need this ability in order to correctly calculate your pricing. We proposed this to the working group. The feedback we got was that 600 minutes was an appropriate starting point for the pro forma, and that's reflected in the document. We understand also that some platforms in the market are operating on the basis of 600 minutes per day. So that's why that specific number is in there. But of course, as a practical matter, the minute count fraction is subject to the requirements of the platform and the commercial and operational preferences of participants. I think the point to make on the price differential and the minute count fraction is that logically it should be the amount of time in a day that the platform is open, and that should be the basis of the relevant fraction here. We expect that this will be one of the points that firms will take away, will want to take a view on, will discuss on a commercial level with their counterparties. And so there may be amendments in member firms' individual annexes. But we feel that the pro forma is a good starting point and provides flexibility for member firms to start thinking about how to document intraday transactions. I think that's a rather neat segue into the next section, where Michael is just going to kind of talk about some key takeaways we think firms will need to think about when they're addressing the digital assets annexes.
Thanks very much, Sam. So I agree. I think that is a pretty good segue. I mean, what we've got here are a number of key points for firms to think about whenever they're looking at using the annex or looking at a digital assets use case and trying to determine whether or not the annex can help them. So it's really just a point of decisions and some considerations to reflect on. So the first is obviously think very carefully about what the relevant asset is and whether a given use case is within scope of the annex. So you're going to need to analyze what's really occurring, what the property is, if it fits within one of the definitions of digital asset categories that are covered by the annex. You know, what is the property? Do you have an asset-backed digital asset or a tokenized traditional security, i.e. a digital token which you own, and what you own is digital property? Or do you have something where the tech is really used to help you transfer an existing traditional security in a more efficient way, in which case you're more likely to be sitting in the platform transferred security buckets? And obviously that will impact which provisions of the annex apply and how they apply, and therefore how you view the annex for your particular use case. Once you've thought about the scope of the annex, you're going to start thinking about whether or not you need to adapt the annex in any way for a particular use case. Is it appropriate to hardwire agreement on specific points that we flag, such as how you're calculating market value, or whether or not trades will be terminable on demand, or how you will calculate the value of margin in particular circumstances? And you might need to think about whether or not to include bespoke provisions. You know, if your use case involves a third party performing a service which isn't somehow, and their default isn't somehow captured by the annex already, it might be appropriate to cover that. You also need to think about how the annex fits in with the wider documentation for your use case. So, to Sam's point, if you're looking at an intraday repo transaction platform and that platform is open for 12 hours a day or 24 hours a day, that is likely to impact on the commercial terms you want in your trading documentation, because the relevant time might be different, or it might vary depending on which leg you're describing. Certainly the minute count that you're looking at is likely to want to vary, because you're going to want that to align with the terms of the platform. And you're going to have to think about how the platform documentation fits in with your trading documentation. Does the platform documentation in some way supplant or supplement the trading documentation? If it supplants it, you might not need the annex at all, because you might not really be using the existing SFT documentation. You might just be trading on the terms of the platform, similar to sort of clearing rules or something like that. Alternatively, it might be that they need to sit alongside each other to make sure you have allocated risk appropriately with your counterparty and ensure that the trading terms align with the operational terms of the platform. The next observation to make is, just because you've gone through this process once doesn't mean you are done and dusted. Every time you add a new use case into your portfolio, you're going to want to look at the Digital Asset Annex again, because it might be that different elections or changes are appropriate for that use case. Maybe you have you enter into transactions which reference platform transferred securities on two different platforms. And in one instance, you regard the platform as a bonus, and therefore you want to waive rights to make trades on demand if the platform becomes inoperable. And on another platform, you might regard it as essential, in which case you might want to maintain that right, or maybe you would want a different right instead. You might want to think carefully about whether or not to make more bespoke modifications. So if you're trading intraday repos on two platforms, you might need to have separate definitions for each platform, so that the economics align for each platform depending on which one you're using. The Digital Asset Annex is a great starting point, but you still need to analyze how it works with each platform and every platform you add as and when you trade. The other point to make, of course, is just the mere existence of the annex doesn't mean that all parties will want to trade all categories of digital asset that are in scope. This is trading documentation. You'll still have all the regulatory considerations and analysis you need to do in order to get the internal stakeholders over the line, and of course to make sure you understand what regulatory permissions, if any, you require, and that it fits into the scope of your existing business lines. So there might be regulatory analysis to be done, and you will likely have to refresh that each time you look at a different use case. As Sam said, we currently don't cover security interests at all. So if you look at a use case which involves the granting of security, you're going to have to think very carefully about how the annex fits in with that. There may be elements you can take advantage of. So, for example, your use case involves assets being transferred into a segregated account of some kind. There's obviously going to be language in the annex that you can leverage to discuss, whether or not deliveries are made into the relevant account. You're going to want to think very, very carefully about how you take security over those assets, what class of security you have. Do you still have a financial collateral arrangement? Should you be taking a charge or an assignment against the rights against the custodian, and how this fits in with your overall analysis? And obviously, as part of that, you're likely to want to think about what sort of opinion treatment you need to make sure that the security is enforceable in the event that your counterparty defaults, and how their insolvency might fit in with it. And obviously, that leads into a wider picture for this annex in general, which is that you need to think carefully about the legal opinion coverage. In order to take advantage of CRR, you might need drawdown opinions. You also might not. Like if you're only entering into transactions that reference platform transferred securities, well, we've already covered how those are in fact one and the same as the traditional securities that you're trading outside the use of this annex. And so it might be that for some jurisdictions, you're not modifying any core provisions and you don't necessarily need a drawdown opinion. On the other hand, if you're entering into trades which reference new types of assets, or where the annex modifies core provisions for the applicable counterparty's jurisdiction, you might want to have a drawdown opinion to make sure you can establish that netting treatment continues to apply. And with that in mind, I'm going to hand over to Tina to run through a few thoughts.
Thanks, Michael. Thanks, Sam, for the overview. So before we close and move on to Q&A, I just wanted to provide some additional colour on the opinion coverage for the Annex. So those of you on the call who subscribe to the ICMA and ISLA netting opinions will know that ISLA and ICMA obtain these opinions jointly, albeit with separate annexes for the GMRA and GMSLA. And currently these are in approximately 65 jurisdictions. The opinions are updated annually, and coverage of various annex to the GMRA and GMSLA are currently included. So the intention is to cover the Digital Asset Annex in certain jurisdictions in the 2025 opinion exercise. The jurisdictions that we are currently considering, this is based on member feedback from the working group, are England and Wales, France, Germany, Switzerland, Belgium, and Luxembourg. So that's likely to be the starting point. But what I would say, if you have any additional questions regarding opinion coverage, please reach out to myself or Dina, and obviously we can deal with those queries directly. So Michael, we have a few minutes left. Have there been any questions that have come through that you haven't answered during the session so far?
Thanks so much, Dina. So there are a couple. There's a couple that we addressed as we went, but the first question maybe is one for you. It comes in a couple of different forms, but I guess you could compress it down to the Annex doesn't cover all forms of digital assets, as we discussed earlier. Is there any plan to expand the coverage of the Annex?
Thanks, Michael. So yeah, obviously, as you previously mentioned, it doesn't cover every asset type. I'd say it's a watching brief for us at the moment. We are anticipating that as the markets develop, we will see increased demand to develop the documentation. So obviously, Dina and I, on behalf of ICMA and ISLA, will be led by member demand. So again, please reach out. We'll be taking feedback from members. So please reach out to us if you have any thoughts and comments on future editions, please.
Perfect. Thanks so much, Dina and Tina. So the next point was, how will digital assets integrate with market infrastructure, and what new infrastructure might be needed? So it's a great question. It's not strictly a legal question, so I'm probably not the perfect person to answer it. But unless anybody else feels particularly brave, I'll give it a go. So my answer is that it depends on the digital asset. So if you look at the use cases out there in the market already, you can see a range of approaches to this. So if you are thinking about platform transfer securities, the reason a lot of people have gone down that approach for use cases is precisely because it more easily integrates into existing market infrastructure. Often it makes use of existing tri-party arrangements or leverages other sort of custody platforms, and that means it's a comparatively light use case to build that into your systems. Whereas if you want to start holding Bitcoin, that's obviously a much bigger lift and requires a lot more work. So I think the answer is how well it integrates with existing market infrastructure will vary by use case. Inevitably, use cases that are easier for firms to integrate into their systems will be able to pick up traction faster, more easily, because it is easier for firms to onboard. But I think each use case will live or die on its own strengths, and some will thrive, and others will maybe stagnate. But I think you'll have to assess it individually. The next question is whether or not the presentation will be shared afterwards. That is beyond my ken, but I can see Dina nodding, so I believe that the webinar will be available.
Yes, thanks, Michael. I think for those that have registered, I think you'll receive automatically a link to the recording, but it will be made available.
Fantastic. So the next question was, what was the most pressing use case that seems to be emerging? I think that's a difficult question for us to answer. So obviously, in some ways, the firms will probably have their own demands and requirements. So depending on your business line and how things are operating, that might make use cases more pressing for some firms than others. Maybe the best way to answer that, though, is to make the observation that during the life of the project, platform transferred securities were deemed to be sufficiently important that they were worth adding to the project, even though the original scope hadn't included them. And to me, that suggests obviously that a lot of market participants were either making use of them or were thinking about trading them, and they wanted to see how the market approached them so they could have some common standards to reference when they're entering into trades. And we had another, oh, that's an interesting question. So one person said that they have borrowed somebody else's invite because they shared it and they wanted to know whether or not they would be able to access it separately. I suggest that you reach out to us and we will see if somebody with a more operational mindset can solve that crisis. There's also a question around what were the reasons for excluding native digital bonds. It's a difficult question again to answer because obviously feedback came from a lot of different firms. I guess Tina and Dina might have thoughts, but my perception was that a number of firms pushed back on it, and my assumption is they pushed back either because they felt that the market was still settling and they wanted to wait for more common standards in relation to native digital bonds, which would obviously mean that any annex could be more targeted, or they thought that it would be more helpful to focus on asset classes which had a bigger market penetration at the time, because obviously the platform transferred securities is at present a potentially bigger market because any existing traditional security can be tokenized and become a tokenized traditional security, or can be transferred digitally and therefore be a platform transferred security. And so there was just more market opportunity, and they wanted the working group to focus on that rather than delay efforts to also include native digital bonds. But
sorry, just to confirm, you've hit the nail on the head. And I think also the demand didn't really come through the working group. So obviously that's where we landed.
Super. So that's very helpful indeed. There's also a question around the governing law of security interests, but I think that would be too specific to focus on. So Sam touched on this earlier around how the pledge documentation doesn't include the collateral leg for digital assets. And there's a number of reasons for that. Obviously, the fact is that it has to key in time very closely with the existing custody arrangements and tripartite account control arrangements, because that's key to the ISLA offering on the pledged GMSLA. And obviously, you can't really drive that from a documentation perspective. I think that really has to be operationally supported by the custodians in order for you to be able to assess what specific categories of digital asset merit consideration. So if you're looking at using digital assets as collateral under a pledged GMSLA, or even something like initial margin in a derivatives context, I think the technology would be very similar, but you would really need to be thinking about how that fits in with your security structure, what type of asset it is, and the answer could vary from asset to asset and use case to use case more widely than it does for title transfer collateral. With that in mind, I see that we've reached time, so I'm going to hand back to Tina and Dina to wrap up.
Thank you, Michael. Well, just to say thank you to Michael and Sam for taking us through that, some valuable insights there and some considerations and questions that market participants will need to think about. Just to reiterate Tina's points earlier, feedback and, future requests are all driven by members. So do feedback to us, any sort of additional thoughts, and of course, any questions, feel free to reach out to us. I'd like to thank you all for joining today. Have a good afternoon.